Good morning, and thank you for joining us. My name is Courtney Yaki, and I'm with the F&M Regional Growth Alliance, and here today representing the Business Navigator Alliance of South Central and Southeastern Illinois. We have an excellent presentation stored for you today, discussing the state of the housing market. Housing is a very hot topic all across the U.S., especially in our rural communities. All throughout South Central and Southeastern Illinois, there are various initiatives to try to address housing concerns and increase investments in residential development. So for today's webinar, we want to dive into the housing market and explore what's been going on over the last year. To guide us through this discussion, we have Matt Forcum of Shelby Realty Services, a local expert who lives and breathes this market every day. Mr. Forcum is going to break down the housing market for us, starting with a national view and then narrowing down to our region. Touch on multiple data points and ongoing trends. But first, what is the Business Navigator Alliance of South Central and Southeastern Illinois? Well, we are a 6-county regional collaboration who originated from working through a small business community navigator grant. Our partners include Rhonda Sauget and Angela Griffin with Coles Together, Lori Miner with the Sullivan, Illinois Chamber and Economic Development, Risa Shaner with the Crawford County Development Association, Nora Swalls with the Marshall Area Chamber of Commerce, Bob Colvin and Freddie Smutty with the Paris Economic Development Corporation, and yours truly, Courtney Yaki with the F&M Regional Growth Alliance. This group is charged with professional outreach and technical assistance for local, state, and federal programs. Our mission is to ensure that small businesses in our region are competitive and applying for necessary resources, and our goal is to position you for success by accelerating business recovery and growth. See the map to the side of your screen where the Business Navigator Alliance is located. Today's webinar is part of a series of webinars that we host each month. These webinars are scheduled for the last Thursday of the month, so please mark your calendars and visit www.ilbusinessnavigators.com, that's navigators with an S, and sign up for our newsletter to stay informed. We also host various outreach events, office hours, and one-on-one technical assistance and offer that one-on-one technical assistance. Again, visit ilbusinessnavigators.com to learn more. We'll post the recording from today's presentation and additional supportive material on the website as well. If you've seen in the chat and had jumped on earlier, had a little discussion, registrants, if you're joining us, you're viewing us today, don't have video and audio capabilities. If you got any questions, please put them in the chat. We're going to run through Matt's presentation and then jump into a Q&A session. So to start out, we have Matt Forcum. Matt is the owner and operator of Shelby Realty Services, a real estate brokerage firm with offices in Effingham, Shelbyville, and Sullivan, Illinois. Matt also operates Thera Ventures, a real estate investment company, alongside with his wife, Stacy. Matt, are you ready to present, sir?
Ready to go. Thanks, Courtney. Awesome. Well, thanks everyone for joining. It's a pleasure to see the attendance we've got here today. Mr. Yaki has asked me to talk with you here this morning about housing in our region. And we're going to go through a rundown of national and state data, regional data, and some other factors that, in my opinion, influence housing. I'd like to disclaim up front, these a lot of the data is here that is factual. It is cited as such. Commentary is purely my own. It doesn't represent any other brokerage participant, brokerage firm, or anything of that nature. So if I get a little off the rails or get into something, I want you to understand that's certainly just my opinion. So Courtney, if we could get started and move through the slides here, we'll jump right in, starting with the topics. Going through, we'll just briefly touch on the national, state, and regional information. Things that I felt were really important to discuss were new construction trends and the confluence of rent versus buy for housing needs for our housing market participants. Financing and lending also being a point there to consider, and how that's impacting a lot of our borrowers and buyers. And then a commentary that's kind of maybe a little vague at this point, but industry upheaval and uncertainty. Certainly not meant to be anything to keep anyone up at night, but there's a lot of changes that we're facing in our brokerage industry that I don't want to lay at anyone's feet, but I wanted to touch on and how that's going to impact potentially buyers and borrowers moving forward. There could be some very substantial changes that happen, and some workflow that's going to have to exist in order to get through that challenge. Courtney, if we can move on to the next slide, please. So to start, a recap of national info. Of course, I'll read this stuff just to touch on some key points. I wanted to mention that the U.S. does enjoy relatively high home ownership. We've got a great percentage here of 66% of families owning primary residences. Our typical home, and as I sit in our Effingham office today, I can say a typical home of 1,860 square feet, 3-bed, 2-bath, built in 1985 is often representative of a lot of the properties that we deal with. We see a range in our region, and any real estate practitioners that are on this call can certainly attest to that. 1985 in some cases is a very new home, in some cases a very old home. So we certainly see a broad range of ages, styles, sizes, and amenities in our marketplaces, but this is a national average. So putting that out there for your digestion, first-time buyers, an immediate household income of $95,000, repeat buyers slightly higher at $111,000. We see the first-time buyer age at 35 years old, which is, I don't have those statistics to share with you, but just off the cuff, anecdotally, we see an increasing first-time buyer age generationally. It's harder for people to buy their first home. It's taking them longer to get financially settled as incomes and household incomes have lagged behind the rapid rise of residential costs. The 84.6 million owner-occupied units in the United States. And interestingly, we see about 60% of those have a mortgage, about 40% of those do not. We've seen an uptick in high liquidity or fully owned non-mortgaged properties in recent years as more cash has come in to the marketplace and buyers have executed with that. That's all I've got for national stuff. Courtney, can we move on to the next one, please? The next couple slides here, we're going to dig into these tables. Some repeat information, but just wanted to share. This slide shows national and state mortgage information. Illinois compared to the rural United States compared to the total United States. And this all comes from Federal Housing Finance Authority National Mortgage Database. So we see in Illinois, which of course includes one of the country's major metro areas and some dense population areas, but we see the monthly payments there across the board being a little bit less in Illinois and the rural US compared to the US as a total. The average interest rates are pretty comparable. Mark to market on loan to value. So as it says there, the ratio of current unpaid principal to the current property value. And then the average loan age, which we have seen increase in the average age of mortgages, which simply means people are holding their existing mortgages longer. So they're allowing those mortgages to age, and we'll get into those details a little bit later, but that's all a result of borrowers being in very competitive, very favorable mortgages, not interested in the discretionary option to make a move. They're not interested in getting out of their current mortgage to get into another property, and so they're kind of staying put. So we see that age start to increase, and I think that's going to continue to do so unless we see interest rates adjust fairly rapidly. Courtney, if we could move on to the next one, please. So now we see kind of a historical perspective here, and I went back in 3-year increments, and as you can digest this information here, we see average monthly payments will certainly increase, and this is for the rural United States, and the sample is Q1 of each year. So we see those average monthly payments increase from just about $1,000 to about $1,450 every year, and we see a decrease in the mark-to-market ratios, which is also very interesting, 62.1 to 49.6%, which simply means that owners and sellers, if they were to sell, have a better equity position. They own more of their home, or they have less debt to service on that property over from 2015 to 2024. Now, that is a ratio which I guess maybe I should back up. I shouldn't say they have less debt to service. They have a better ratio in relation to their fair market value of the property. So that is a combination of debt service pay down, but also the other side being increases in property values. And that's the big consideration here. I think we've seen increases in property values alongside people cashing out of their mortgages and being debt-free on a residence. Again, the rural US, we see the total outstanding loan volume in billions, moving from the 1409 number to the 2143. So we've seen an uptick on that. There's more borrowing that happens overall in the aggregate, but people are ultimately in probably a more conservative, better financial position in their homes now. Mr. Yaki, if we could move to the next one. And the last of three, this slide, just to make sure of what I've got here, this is the full US. compared to just the rural United States. So we see the average loan age moving up in months. We see a drastic increase in the average monthly payment from $1,200 to $1,800. We do see the softening of average interest rate, and we see the better ratio for mark to market for the loans. Folks that do have a mortgage are a little better positioned on their mortgage based on their property's current value. And of course, the outstanding loan volume has seen a strong uptick. So we see more borrowing overall happening as well. Again, I think buyers, or I should say owners of property, those that have purchased, are in a better financial position for a number of factors. They've got more stable loans. They've locked into good interest rates, and we'll get into that a little bit more. But I wanted to lay out this kind of historical perspective with some of this data. Courtney, if we could move on to the next one. This illustrates, this is from the St. Louis Fed, the Federal Reserve economic data, shows the just spike, for lack of a better term, in available home equity with 32.7 trillion, which is a record high. And recorded since the St. Louis Fed has recorded this. A wonderful number. I mean, we've got homeowners that are sitting on massive amounts of personal wealth in their home, keeping in mind that that's a market commodity. So that price does fluctuate. And right now we're looking at some stuff we'll get into later in the presentation that talks about ways that homeowners can tap that equity and how they can exercise that rather than just simply have it in the real property. Courtney, if we could click to the next one, please. Residential sales regionally. This is really kind of the nuts and bolts of what we want to talk about here. We limited this to the Business Navigator region, which essentially runs from Christian County, Taylorville, east to Edgar County. Courtney, you may correct me here. I think we go up to Douglas and then down to Effingham, roughly, that multi-county area. But I pulled this information from our Central Illinois Board of Realtors. So this limits the information to arm's length marketed transactions where we had sellers that were engaged in a fair market transaction, buyers that were engaged in a fair market transactions. Does not include, estates that passed on or closely held sales or other things of that nature. So this is a limited perspective, but it speaks of the open market pretty broadly, I think. We saw just over 1,500 total residential properties being brokered. That includes all single family properties, most of which were single family detached, what we call a conventional, detached home. Some 33, a very minor percentage here, just over a couple percent, were townhomes, duplexes, condos, or attached properties that were single family. That price ranged from $5,000 on the low end to $1.6 million on the high end. The low end houses were, this is aggregate information. The low end houses were, poor condition properties that were probably demolished, used for other purposes. 1.6 million represents that specific listing was on Lake Sarah near Effingham, and that was a residential property that we would probably see as definitely the high end of the overall regional market, more executive home or a second home or recreational property for a buyer. What we did see, a very tight list to sale ratio here, sale price of 130 on a list price or asking price of $135,000 on an average or median rather of 1,468 square feet for that residential structure. But what I found most interesting was 9 days on the market. We're seeing properties sell just over a week. They're coming on the market and they're going off the market just that fast, which just means that we've got buyers that are well positioned. They're well qualified. They've got their financing in order. They're being hopefully represented or guided by a professional that's helping them explain the process. Sellers the same way. They're being represented and explained the process because we're moving this inventory very efficiently. And that also just simply means that that's a competitive thing with buyers. They've got to be ready to go. They've got to be ready to pull the trigger, understand that they need to execute when they find the property that fits their needs and wants. And we see at a granular level, which we'll touch on here just briefly a little bit later, we see those marketplaces functioning very granular. That could be a house in the same neighborhood performing differently than another comparable house. So it's really up to the combination of what the seller has to offer in their asset, what the buyer's looking for. And when those things are well aligned, we see strong buyer appetite and a lot of buyer competition in the market. Courtney, if we could bump to the next one, please. Again, the BNA region, we saw the single family sales. This just breaks down the 1,544 and the 1,511 that were detached to freestanding units compared to multifamily sales. This is going to segue us into the rent versus buy and new construction stuff to speak about multifamily or commercial investment properties. In 28 transactions, we saw 86 units be conveyed. And the average cost per unit, $44,000. It probably doesn't mean much to a lot of folks unless you're in the multifamily rental space. You understand the cost of the doors there. But this is on an average gross income of just over $6,000, which is, right at $500 a month in gross income. Which essentially is a 4.6x trading multiple. So what we see here is, I would say that is probably representative on the multifamily stuff, probably representative of properties that are held by owners that are divesting because they have a small portfolio. Maybe they just want to exit it for tax reasons. They've got depreciation considerations. They want to move on. Or properties that need renovation. They need some capital to be injected in order to raise those rents a little higher. And they're just in a marketplace where they're going to have trouble doing that. So those owners are exiting. I would suggest, and other practitioners may have their opinion, but I would suggest on larger units that are more professionally managed and that are a higher price point, you're probably going to see those units not be brokered potentially by a local broker. They may not even be advertised. That may seek a different market channel where closely organized investor groups that invest in multifamily may transact that with a lot of times private capital being injected. There's not going to be a for sale sign out front of the property. But overall, what I see in my marketplace is a lot of multifamily stuff isn't being transacted if it's held by a larger organization. If it's cash flowing well, they're making a good return on that. So they're happy to stay right where they're at. Courtney, let's bump to the next one as well. Right. Yep. Just segue us, as we mentioned, into new construction, the importance of household formation, what that means, and the rent versus buy information. So new construction, one of the underlying tenets of how price is discovered or established in a marketplace is what's the inventory of new construction? How many new units are we adding to the available pool that buyers can choose from? So the supply side of supply and demand. I'll let you guys digest this stuff, but we work back in annual measurements. These numbers are in thousands. They represent Q1 of the respective years. The important thing is we saw a good increase year over year from 2023 to 2024, particularly on single family fee simple properties, simply meaning that the residence was built speculatively for sale and it's fee simple. So it's not part of a condo association. The developer owns the land the property sits on and owns the structure, and they're conveying it that way, which is very much what we would see the majority of our marketplace be, a fee simple transaction for the entirety of the real property and the attachments and improvements thereon. But we see a big decline in the number of multifamily built for rent units, both in terms of the 0 to 20 unit category and the 20 plus unit category. And I would suggest, particularly in the 20 plus category, 20 plus unit category, we're looking at particularly institutional investors. We're looking at big private capital. We're looking at people that do this for a living, and 20 plus units, maybe even a misnomer. You're probably dealing with people that build in the hundreds, if not thousands of units and doors at a time. Looking at marketplaces that are probably more dense, more metropolitan in nature, and they're going to come in and say, I want to build 300 or 1,300 units, building a tower, building whatever, and I'm going to put that together. So we've seen that slow down. The point of that comment is those wheels turn slower. Those are more respective of the ebbs and flows of construction costs. And I think we'll see as construction costs have softened, particularly in the lumber markets, if they're doing wood frame construction, we may see that pick up. If they get good buys on raw materials, it may be advantageous for them to do that. But we do see the single family homes increasing in appetite. Just anecdotally, we see a lot of that development in the Sun Belt. We see that in Texas. Florida has some restraint due to, which we'll talk about later, insurance regulations. But Texas is a very growing economy. And we see a lot of population density thriving there. And developers like Lennar or D.H. Horton coming in and planning 1,000-unit freestanding subdivisions. Big stuff compared to what we typically see in Central Illinois. Courtney, if we could move to the next slide, please. Something that I felt was very important to discuss was the aging units that we have for existing inventory. So we see here, if you look at the red slice, right, kind of top dead center, That's the year 2020 to current. And so new housing unit age, we see that 2% number of housing units that are in the marketplace now, or that exist rather in the US, are from 2020 or newer. So we've seen a slowdown of housing starts post-COVID, and we have seen continuing aging inventory. Now, this Fed data only went back to 1939. And any market practitioners or participants that are on this call could certainly attest. We see a lot of homes in our market areas that are older even than 1939. They continue to sell and continue to be in good condition, livable homes. So I'm not trying to disparage that. But what we get into with that are a few things. We get into, and I'll do this actually in reverse order. I'm going to speak to physical deterioration. We see homes that simply have deferred maintenance, or because we're an area that experiences hot temperatures in summer, very cold temperatures in the winter, we see that that's hard on wood frame construction, which is most of what we deal with in our marketplace. So homes have a life cycle. If that's 80 years or 100 years or 150 years, but there's a finite life to a residential structure. And we're starting to see those properties, really reach that limit of what can we do to keep this structure a structure before, we see towns, particularly smaller towns all the time. Maybe you have a home damaged by fire or abandoned or something, and the house eventually just gets demolished and you end up with a grass lot that doesn't get backfilled. And that's the physical deterioration toll that we have on houses that come out of the marketplace. Energy efficiency is an increasing thing that I wanted to speak about. Older homes especially, and this goes somewhat to family and lifestyle factors. We don't have families raising 8 kids at home, 9 kids at home. Families are smaller. Their needs for housing adjust accordingly. We don't need the big homes. And so the energy efficiency of heating and cooling, maybe 2,000, 3,000 square feet compared to something a little bit smaller, alongside the mechanicals that are there, that may be older mechanicals in a home, just simply don't have the efficiencies of what newer construction technology offers. So we see that be a consideration for buyers. They're very interested in knowing, what's it going to cost me to heat and cool this home? Does a home have new windows? Does it have a new roof? Does it have insulation, et cetera, et cetera? All those considerations and the investments that we see home sellers potentially getting a good or better return on their investment by investing in some of those things and maintaining their home's life cycle. And then functional obsolescence, that kind of circles back to the lifestyle factors. We see smaller family units in household formation now, but we also see on the other side of that spectrum, larger households being formed. So you see young couples that aren't having children as early in their relationships or in their household formation, or maybe not having children at all. So they're not bringing additional persons into that household. They don't need the space. We also see on the other end of the spectrum, larger multi-generational households being formed. We see parents moving back in with kids or other family members, kids not leaving or returning to the household of the parents. So you have households that have a lot of layers. There's a lot of living going on in the house. I guess I'd put it that way. And the housing needs have to be respective of that. Things like just simply, how many bedrooms and bathrooms do you need? And do you have enough parking spaces for the people in your house? Things of that nature. So a little broader than just housing unit age, but something I thought we needed to talk about. Courtney, if we could bump to the next one, please. So we'll get into now, I think probably a big topic, something very familiar to everybody on this call, the housing shortage. And I think something that we see, this is titled National Housing Shortage, but I think we see it all in our hometowns or the towns we reside in, the communities that surround us. We see a lack of new inventory being built. We see limited new developments. And this speaks to the national stuff. This is from Move Incorporated, which operates Realtor.com. And some of their commentary that said that we were 6.5 million units short at the end of 22, and that has widened to 7.2 million short at the end of 23. As household formations have surpassed, the acceleration of household formations have surpassed the development of new housing inventory. And those numbers are all residential. That includes multifamily and single family detached properties. The next paragraph talks about a much narrower gap, but it incorporates new multifamily starts compared to housing formation. So what that really talks about is, we have this shortage of raw units. Um, and those raw units in all single family, the uh, the 7.2 million really kind of demonstrates housing as a necessity, housing as shelter. We're simply that many million units short for the amount of families, meaning those families are occupying a multi-generation or a multi-family occupancy. There's more than one household in one structure. But the next layer, as we talk about the 2.3 million to 2.5 million, that does incorporate how multifamily has offset that. So what that speaks to is apartment buildings or multifamily complexes softening up that gap. So people do have shelter. It may not be where they want to live. It may not be the accommodation that affords them and a changing family dynamic, all the needs and amenities that they have. They may be, a growing family in a shrinking space in an apartment. And they're not being able to get out. That's more of a discretionary statement, getting out of an apartment or potentially a smaller space into that single family detached unit. So we still have a deficiency there. But I wanted to talk about how much we see a rawness of uh, needing housing as necessity and as shelter versus we still have a discretionary housing gap of folks that would probably rather move or transition from, I would suggest, arguably a smaller space into a larger space, move from the city density to the suburbs, whatever that means for our individual communities, move from town to country, move from apartment to house, etc. We still have a pent up demand there, and we'd like to, explore that a little bit later, but it just shows, the need for new housing inventory as we move forward, even in our own communities here. As I think these numbers apply very well to what we see in our own communities. Courtney, can we bump to the next one, please? This is just a chart that illustrates that. This is, again, from realtor.com, but it shows the shortage of supply. The red line being the total, including single and multifamily units, and the blue line down at the bottom being 7+ million units apart, representing if we filled that gap just with single family detached homes, what that would take to build. If we built, new 1,500 square foot ranch uh, uh, properties, how would that solve that problem? Courtney, I'm going to defer to you. I noticed we had a question here in the chat. Do we want to address that, or do we want to hold until a later time?
If you want to go ahead and address it, by all means.
Sure. Okay.
You want to speak towards ADUs?
Yeah, absolutely. So I'm just going to read here briefly. What is the attitude of the region toward accessory dwelling units, or ADUs, to address the needs of multi-generational housing? That's a fantastic question. It really is. So let me touch on accessory dwelling units. That's not something that we see a ton of, but we're starting to see increase. Accessory dwelling unit, in broad strokes, is just simply an additional dwelling unit on a parcel that has a primary dwelling unit. So you have a house, and now you have maybe a tiny house or some structure of permanence, not a travel trailer, camper, or temporary shelter, but some structure of permanence that allows for separate, private, full enjoyment occupancy on the same parcel. Again, I'm going to say a tiny house or something of that nature may be put in, or it could be a freestanding structure. It could be a guest house. It could be a converted garage. There's a lot of ways to become an ADU, or accessory dwelling unit. But what we see in our marketplaces, I'll speak to, specifically to what I see. And I see the conversion of garage spaces or non-residential, maybe non-conditioned spaces into conditioned spaces. They're incorporating that. Now, a lot of times that incorporates into the overall envelope of the existing house, but a lot of times it also represents a multi-generational, particularly for aging populations, when a parent or grandparent moves in with another family unit and they want to be in a space that maybe they have considerations for. They need a small space, still need privacy. They don't want to navigate stairs or something of that nature. They're close to an exit. It's easier for them to enjoy their life in that unit. As far as a regional attitude towards that, to speak to the heart of your question, I can't answer that. I don't know that there's a consistent regional attitude towards those units. We see varied zoning and policy making decisions on that from community to community and county by county. Some places have no opinion. They haven't addressed the issue. Some communities have addressed the issue, and often we see stringency applied towards ADUs. And I think zoning, we'll talk about that a little bit later in the presentation about potential changes that we can make as communities, as stakeholders and decision makers, how to alleviate some of this stuff. I think it's a fantastic question, and I think ADUs offer a lot of promise to help alleviate, particularly in multi-generational housing. So we'll explore that just a little bit more later on in the conversation. Courtney, I hope I covered that well for everybody, but I think everybody's got the gist of what I said in this chart here. So I think we can move on to the next if you'd like.
Perfect. And Freddie, thank you for your question. And just to remind everybody, if you've got questions, please put them in the chat. You did an excellent job addressing the question, Matt. Appreciate that. I know there's a lot of conversations going on with our various communities around South Central, Southeastern Illinois about leveraging ADUs to try to help overcome some of these shortfalls. But excellent question, Freddie. Anybody else has questions, please put them in the chat. Thank you.
All right. So rent versus buy. This is a big topic and an increasing topic that we see here. I want to look at the bottom left, and I apologize, this is maybe a little smaller than I should have made it. The bottom left chart here, the dark line shows the cost of a new mortgage payment. And the lighter line, it's kind of a light blue, shows multifamily rents. And this is a national statement. This is courtesy of CBRE, which is a fantastically intelligent investment property brokerage and consultant firm. They have a lot of data, and they are very good at what they do with it. So this just talks about, kind of shows or illustrates rather the consistent increase of multifamily rents that we see a nice steady uptick there. And then we see the vacillation in the dark line of the new mortgage rates. And what we see is, definitely and drastically more expensive to go secure a new mortgage. But although we're kind of narrowing that gap, we saw that those, I guess I'd speak to maybe the COVID or slightly post-COVID years. And now we see that gap narrowing a little bit as rents have seen an acceleration. But what I'm afraid of is landlords pay attention to what it costs to buy a house, and sellers pay attention to what it costs to rent a house. So we have a bit of a play there. Nobody in a free market wants to minimize their returns. So we've got these market practitioners and participants that are saying, well, if it costs you X to rent, then I want to be Y to buy, and vice versa. So we see a little bit of almost a vortex, for lack of a better word, on these stabilized and increasing costs to renters, tenants, or buyers for purchases of homes. And those costs are very stable. And I just don't see a good way that those go down unless we see the value or the interest in either multifamily or single family homes decrease. And that would be if we take the inventory pressure off the single family side by new housing inventory or low interest rates. So sellers want to move, they want to put their inventory on the market, or we see some sort of financial pressure on multifamily. And I'm not sure that I see that happening. That's my opinion. But just to touch on the commentary here, we've seen these costs increase, but I think we're going to see them stabilize, absent the wild card factors. And I'm not going to get into these weeds, but the wild card factors of national, global unemployment, domestic, geopolitics, the crazy stuff that we could all talk about for hours, but the things that are probably above our pay grade in the grand scheme of things, and how the markets would react to any of those potential externalities. Courtney, if we could bump to the next one. So we talked about rent versus buy, and now into household formation. The graph here is in the top right corner. This is separated by decade, household formation by decade in thousands. And the very right edge here, we see the dark green was 2020 to 2023. And then the kind of obviously different looking column is the 2020, using those 2020 to 23 numbers, is the projection of 2020 to 2029 household formation. And we see a fairly steep decline going from what would otherwise be a pretty consistent trend from the 1980, or even if you want to look at 1970s into the 2000s. We see a little bit of up and down, but a fairly consistent trend line, and then a drop off in 2020 and beyond. So we see a notable reduction there, and really this is the as we talked about, the nuclear family being replaced by multi-generational living arrangements, children not leaving and so forth. So I think the question kind of lingers, do we see household formation slowing because of economic pressures? Are we seeing the availability of housing impact young person's desire or their perceived ability to start a family, to leave the home that they're in, wherever that is, and create their own household and move on? And I think that's a very real thing. Again, not to speak to some of the other factors that may play into that, but I think it's a real thing, and I think we may see folks, not live with their parents, quite frankly, if they had the opportunity to make a purchase of a home that was more in their capacity to afford. Courtney, let's bump to the next slide, if you would, please.
And Matt, real quick on this one,
Sure.
are you seeing this shift and this trend, and most certainly seeing the top right corner of how that's come down for 20 to 23? Is it because of that shortfall? Is that speaking to it, or is it just the overall consumer behavior and how demographics are starting to shift overall?
Well, that's a fantastic question, and that's something that I think is probably beyond my capacity to answer intelligently.
Understood.
And just simply because, and to touch on that, I think we all kind of understand some of those variables, but young people are faced with pressures of student loan debt is a factor, increasing costs of vehicles, and this is not just young people, but every household, right? We all know what our household budgets have done, and we've seen that, and the younger persons may be faced with limited employment prospects in their area. So if they stay in our region and they don't have an employment opportunity that is kept pace with the increase in housing costs, they may simply have nothing more than an economic decision to say, I'm not financially prepared to start a household. I'm not ready. And we see that kind of expressing itself. So I don't want to say that, I don't want to get into the correlation causation argument here. I don't know what is, the chicken or the egg, but we are seeing people start families later in life, wait to get married, maybe not get married, choose to have children later, maybe choose not to have children. We are seeing multi-generational living arrangements. So we're seeing efficiencies happen in the marketplace. Just in an economic sense, we're seeing persons in households and in family units seek efficiencies as it expresses economically in housing. Now, whether that is because of liquidity, because of borrowing power, because of available housing inventory, or other factors, I don't know. But it's definitely kind of a swirl of a lot of things, in my opinion.
I'd agree with you. I'd say multiple of different factors affecting it, but definitely can identify some higher ones that may influence some of those decisions, and just what we've seen overall consumer behavior, and then the household formation is what trends have happened. Appreciate you expanding on that.
Sure. All right. So here's some statistics. This was put together from our local Realtor Multiple Listing Service, Central Illinois Board of Realtors Multiple Listing Service. So I analyzed all those 1,500 and odd sales for how were buyers financed. And what we see here, we see a total. I just want to speak to the 78% of buyers as borrowers or potentially not borrowers. They were conventional loans or cash purchases. Which simply means that that buyer profile as a borrower was creditworthy. To get a conventional loan, they had some amount of liquidity. They had a good credit profile. They were the bank or lender was probably excited and interested to underwrite their loan. And it was not it was not built to be a secondary market layoff for a government-sponsored entity. So it wasn't an FHA, it wasn't a VA or USDA loan type. So that said, that tells me that we're dealing with buyers that are in really good, conservative, well-positioned financial perspectives. We've got good, qualified, credible buyers out there looking for housing. So that increases the competition, especially amongst the cash marketplace, which we see in my business, we see a lot of in discretionary purchase, second homes, things of that nature. And this only takes into account residential stuff. So we're not talking about commercial or farmland or anything else here, just residential units. But those strong cash purchases particularly really speak to the amount of liquidity in the marketplace, number one, and two, the interest in home buyers to deploy that capital to make a purchase. So that I'm going to kind of take a brief sidetrack, but I think a lot of practitioners would be able to argue and be able to see in their own business, if they're in the real estate business, how that has negatively impacted those FHA, VA, USDA rural development borrowers that maybe don't have as much discretion on physical condition of a home, or as much discretion or latitude on being in a competitive bidding buying marketplace. And those home buyers have been, I would say, disproportionately affected by some of these factors that have really slowed down their ability to make acquisitions. When you have a seller with maybe a multiple offer situation, and an FHA or a USDA borrower, or a cash borrower, conventional loan borrower, all those things factored into, as a listing agent, how that seller efficiently conveys their property. And that's not to be disparaging about any of these loan types or discriminatory in any way, just simply the economics on the seller side of what's best for me, how do we move forward here? And seeing that, I think we see those sellers, opting to take that conventional or cash purchase in favor over some of these other loan types. So we definitely see that happening. At least I see that happening, I should say, in my marketplaces. So we see those, unfortunately, those borrowers, and I've got kind of some expanded conversation here as it relates to those borrowers on this slide. We see those borrowers have, as I mentioned, limited discretionary ability for one, to enhance their household incomes. They're usually of a profile where they can't walk into work and say, I need to double my pay. They may not be self-employed. They may not be in a position where they can do that. So they're very constrained based on employment. If their employment hasn't kept up with the inflationary trajectory of housing prices, they're further and further behind the curve. And that becomes an issue. We see a rise in what I'll call the floor value of existing inventory, right? We've just simply seen prices go from here to here over years. And that impacts, I would say, the lower price band, again, more disproportionately. That has to do with affordability. If you get under $100,000, the economics of that buyer are better for that person. You can afford more. It's a single person or a two-person household, two-income household. Easier to afford, less dollars to borrow, right? Very simple economics there. And we've seen that less in the higher end, which tends to be those executive homes or those second, resort or entertainment properties, quite frankly. In that property spectrum, there tends to be more of a glass ceiling. You're also tending to deal more with a buyer that isn't looking at a structure for necessarily as a primary residence, or they're not looking at it in terms of shelter. They're looking in terms of attributes and amenities, and they have some discretion there. And they probably have, if not liquid capital, access to more capital. And they can make the decision, well, if I don't find what I want in the market, I'll build what I want, buy the lot, and I'll make the construction and go through that way. So different ends of the spectrum there. We also see, I think, back to our lower end borrower profile. We see those folks being financially limited, and we see them, trying to maximize their options for things like seller credits, closing costs, transactional inputs from the seller side, and down payment assistance programs. All popular things with lenders and agents. And we're seeing an increase of that where the buyers are at a point where they need some cash inflow to make their loan work. And the lender has to kind of, do those things that some of those loan programs allow for in order to qualify that borrower to proceed through underwriting. So we see that. We also see, generally home buyers kind of moving to the older demographic. We talk about that, the 35-year and up. And frankly, I'm going to kind of segue into the next slide, if you would please, Courtney. We start to see less discretionary home sale. And that kind of takes us into this. What I mean by that is we see less and less folks just simply saying, I want to move across town. My house is red, that house is blue. I want to move to that house because I can. We're seeing less and less in that. And that it kind of hits the nail on the head. This chart here, this wonderful chart from Visual Capitalist, the mortgage rate surge. What we see, the red line is the mortgage rate. The blue line is existing home sales. And what better mirror image than that right there, as we start to see the mortgage rate massively increase and home sales in mirroring that massively decrease. So that comment about kind of discretionary spend or discretionary movement is illustrated by this just quick math. And you're all smart folks and probably calculated some of this stuff yourself, but just as illustrative example, if you're at a 3 3/8 mortgage here, 30-year on $240,000, your payment's $1,061. You're going to pay $141,000 in interest. You move from that house, which is what your mortgage is today, across town to that different house. You're in a black house, you move to the white house or whatever, you go to a 7% mortgage. And that's, rough to where interest rates are today. You're going to increase by $500. I mean, you get a 50% increase in your monthly payment overnight, just because you went and locked in a 7-year, 7% 30-year mortgage, and paying almost another $200,000 in interest. That's keeping home buyers, or excuse me, keeping home sellers exactly where they are. They're staying put. That also has to do with work from home opportunities. They don't have to move for employment. They can be employed and be gainfully employed right where they're at. So we're seeing a lot of those things happen, and we're seeing a lot less discretionary moves. So we're seeing a lot less inventory come on the market. And that I don't think changes unless we see interest rates change to at least get back competitively to that 4% or sub 4% that so many borrowers are locked in, those very, very competitive mortgage rates. And that's all I have, unless Courtney, you have anything on this slide. That's all I have for this one. I'm ready to move on to the next. So this next slide, the Case-Shiller, which is a product of CoreLogic, Case-Shiller Home Price Index, shows on the left April 2020 to April 2024, and the home price movement here. So that shows this, drastic increase in prices. Everybody's seeing that. Everybody's probably experiencing that firsthand. With if not yourself, people that you're close to, family members, seeing the price rise. So I just wanted to illustrate this. And that's roughly a 45% increase in home values in 4 years. And not to go off the rails, but we all see, again, our household budgets, cost of necessities of groceries, prescription, utilities, gas for our cars, the cost of purchasing a vehicle, et cetera, et cetera. The individual things that we all experience in our household have not necessarily gone down in price to offset this 45% increase in housing. So the inflationary pressures from all angles on the household, and what that means simply for a buyer to say, maybe I'm not in a position to make it. Maybe I'm not in a position to take on the additional square footage and the utility costs that may be, or just simply the elevation and acceleration of that floor value. My home, as a seller, I get a good return on it, but as a buyer, I'm equally offset by putting that increase that I have in my equity right back into my next purchase. And that's apples to apples in communities without any conversation. And I don't see the need to get into the conversation of folks that transition from one community to the next. You may have marketplaces that are low versus high. That certainly happens. But that, to me, as a practitioner, is the only way to leverage a home sale, is to take a community where you've seen this massive increase in values and take it to an area of the country that sees a depression in value, where you get to capitalize on that. But you got to be prepared to move to wherever that is. Not everybody's able to do that or wants to do that. Courtney, if we could bump on to the next, and I'm trying to keep us on track with time here. Hopefully I'm not too far off the rails. Uncertainty and upheaval. Again, this isn't to scare anybody, but I'll let you guys read through this. Guys and gals, read through this, and everybody that's with us, to take a look at this. And I just wanted to comment on some of this stuff. I wanted to comment on some things like underwriting, that we're starting to see underwriters become increasingly scrutinous of properties. In just off the cuff here, I mentioned roof, site drainage, water quality, et cetera. Things like flooding and flood zone criteria. We're starting to see lenders really scrutinize water quality. We're starting to see them really scrutinize well and septic condition. And these all represent things that are kind of unbudgeted pinch points for a buyer. If you get into a rural home and you have a septic problem, that's a $10,000, $15,000, $20,000 fix. That's a catastrophic failure that you don't have the choice to fix. You need to get it fixed to continue to enjoy your home. And you may not be in a position where you have the budget to make that capital outlay, and you may be fairly tapped out in credit for the home purchase. So there might not be any money left from your current lender to offset that. The roof, the same way. All those factors. Some of that goes into, as our practitioners know, FHA and government-sponsored entity loans examine a lot of physical condition to make sure that health, life, and safety is accounted for their borrowers. But some of it just goes into conventional loans, and private monies where they're looking at it and saying, if I'm putting my capital into this loan and it's a 30-year life cycle, am I making a smart investment here? Is my money going to be sound for what has historically been a very, very safe investment? Real estate investments and real estate lending for particularly community bankers, community lenders in their portfolio. And now it's getting a little more granular, and we want to make sure that doesn't become a bad loan due to some of these other factors. Courtney and I talked about this a little bit earlier this morning, the impacts of insurance premiums. And we see that in California, we see that in Florida on a macro level of, entire national firms exiting the state and saying, hey, after July 31st, I'm not going to write a new homeowners policy in California. I'm not going to write a homeowners policy in Florida. If you have a roof over 15 years old, I'm not going to insure it. If you have a trampoline, I'm going to drop your insurance policy. All these things that we've seen some of here in our communities, but a lot of in bigger, more dense areas where the acceleration in house value and replacement cost has so drastically outpaced their ability to collect premiums that they're out of balance. And they just have to say the economics are we need to leave this marketplace, or we put our other marketplaces at risk. And overall, just the increase in insurance premiums, the factors or the perils that we face here, wind and hail damage, increased tornadic activity, and that segues into climate change. We're seeing climate change happen. It's not necessarily an abrupt thing, but we see storm and tornado activity increase, hail activity increase, wind damage increase. We see 100 and 500-year rain precipitation amounts happen that we just experienced in some parts of Illinois, and probably may have impacted some folks on this call. We saw it from Wisconsin and Minnesota and Iowa, and we saw it just recently in Southern Illinois, where we have low head dam failures that result in evacuations and result in really, really big problems for communities and catastrophic challenges to deal with for these communities. All things that lenders are looking at, all things that borrowers and home buyers may be and making sure that they stay on the right side, the intelligent side of those things. And kind of my last thing here, I wanted to talk about industry changes. Any real estate practitioners we have on this call are probably chuckling. They have had their heads beat in on this stuff. But we are seeing in our industry, we're seeing some major changes. We saw some litigation happen, and it's on the national news. You can certainly see it if you go looking. But what it means is we're having a conversation, and we're going to experience some changes as a brokerage industry on how we interact with our customers and clients and how we as practitioners are paid for doing it. The short answer is, this is my opinion, we may see increased costs to buyers. Part of this is how the buyer and seller compensation works. And we're kind of decoupling the commissions in our industry. And that may result in market participants, practitioners, seeking compensation directly from buyers in exchange for the work they do, which is not kind of the historical perspective. So what that may mean going forward is additional layers of affordability for buyers, or buyers increasingly asking sellers to compensate them for increased costs that they have to bear. So things that may impact the negotiation, that may impact buyers, particularly those first-time buyers, ability to find representation. The folks that, as we see so often, the folks that need a service the most are sometimes the ones that it's most difficult to get to. But we're going to see a lot of changes there. I wanted to talk a little bit more about kind of some of the last stuff here that I had. And this is really more speaks to the heart directly to the folks on the call that are decision makers or stakeholders or policymakers in our communities. And do we have another slide after this, Courtney? The folks that I've talked to, these are the big, the macro, the big, hairy, fuzzy things that we're going to have to deal with, is examining how we interface with workforce development challenges in the prioritization of affordable housing. And I have this regularly speak to people with different size firms that need the headcount, and they can increase the headcount. They have the factory space for it, and they're ready to put the assembly lines in, and they need 300 more people to work there. And we don't have the housing to support that. We don't have the housing in maybe a 30-mile radius to support it. Becomes difficult. So I look at, and this is not to sidetrack too much, but I guess the kind of the old days, the coal mine and the company store concept, and then we've seen the importance of retirement, 401k, and health insurance be a part of employment. I truly think housing affordability is going to be the next employer hurdle that's really going to be employers setting themselves apart to say, we can help subsidize a mortgage. We can help subsidize housing. We can offer some affordable housing opportunities to you. Not in a kind of a crippling way, to use the coal analogy, not to pick on our friends in the mining industry, but some of the behaviors that were in history to how they are now. I just simply think folks just need a little bit of help. And I think companies that are if they're in a great position, they're flush with cash, that may be a great deployment of their capital in order to invest in their workforce. So I challenge employers to consider that one. Taxation policy in response to a shrinking tax base, as we have an aging tax base that gets more favorable property tax treatment. We see people moving out of the area, so we see a shrinking pie but increasing costs. It's a big question for local governments. How do they minimize that? Are they prepared to maybe meet the challenges of shrinking government services? Are their constituents prepared to accept that? Big questions there. And I'm not going to get into the rights, wrongs, ups or downs, any of this stuff, just laying it out there for your thoughts. Zoning changes, and this kind of goes to ADUs. We talked about, incentivization of new residential development. I think we need to really challenge our communities to look at zoning changes, to look at deploying options like tax increment financing for residential development, to look at mixed use development, planned use development, things that are going to allow capital to flow in, things that are going to allow new construction to happen, and then embracing new construction technologies, things like the post frame slab on grade, colloquially called barn dominiums. So you pour up foundation, you put up a post frame building, metal sided, very efficient, very maintenance free, but not always met with an embrace by some communities and by some neighbors. They simply say, hey, that's different, I don't like it. Right? Prefabricated construction. That's the last point that I'll end on. That's something that I'm very excited about, and I think is going to be really a wave of interest in our communities. I think we're going to see the prefabricated, manufactured, modular construction be a great answer to how we move forward to some of these challenges. We've got great local builders. We've got great local labor. We've seen lumber become more affordable here post-COVID and kind of bottom back out, but we still have a time frame. Our builder crews can only frame so many houses in a year, and the pressures to build and build more rapidly are there and growing every day. So I think Billy Davis here just commented in the chat, the 3D printed homes, et cetera. I think that's spot on. We're going to continue to embrace, concrete technology, slab on grade, prefabricated construction, environmentally efficient and environmentally friendly constructions that may be aesthetically different than what we're accustomed to, may be functionally different in terms of the size, the space, the layout, the elevations that we're accustomed to. And I think communities will be eventually, if they're not already, faced with the challenges of embracing that. The ADUs, embracing those opportunities to say, this is how we get more people into housing and into affordable housing. Simply just ending on the sentiment that change is going to happen. It's going to happen whether we embrace it or not. But there's a lot of challenges, and those aren't for me, but for those decision makers and policymakers on this call, a lot of challenges at your doorstep to decide, are we going to be in an area that has growth or not? So that's the end of what I have. Courtney, I appreciate your time. Appreciate everybody else's time. And I think, Courtney, what we're here for potentially another 30 minutes for Q&A as needed.
Yeah, so we've hit the 1 hour time frame. Hope that you're still with us. If not, definitely understood. You can't hear this anyway if you're not with us. But the copy of the recording, link of the recording was sent out next week of this presentation, along with the slides here. So Matt, first and foremost, wonderful presentation, info packed. Thank you for educating us. Thank you for taking us through the housing market. I mean, you hit on a tremendous multitude of different things, going from the national view down to the region, and appreciate the opportunity to interject some questions in the presentation. Maybe I'd live a little things, put you in a hot seat a little bit, if you will. But if you got any questions, please throw them in the chat, and we're going to dive into those. We're going to have a hard stop at noon, so we've got a little time for some questions here. Hope that you can continue on. Understand if it's not in your schedule, you've got to go do something, you can catch the recording later. I've got a lot of chicken scratches. I've been writing down a bunch of notes from your presentation today, Matt, and looking forward to going back to the recording myself just to hear it and to dive into it. But to get started, and right here, a question that just came in off of the chat. What can communities do to attract investors, developers, builders, etc.? And really kind of expanding off of the last slide that you had there for the decision makers. And I was going to ask a question, so I'll kind of just attach it onto that one of what are you seeing for trends on a nationwide level? What are you seeing that maybe is working in other communities, other states, other areas of the U.S. That maybe we need to be paying attention to and take those best practices and see if they make sense here?
Yeah, fantastic questions and fantastic conversation to have. I'll jump right in and say, residential development, the inflow of capital and how to attract that. I think we've got a couple layers. You've got bureaucratic layers, things like zoning. Can we put multi-housing, multifamily units in this part of town, or can we rezone this lot that maybe it doesn't meet the minimum lot size for this, that, or the other, what I want to do. But if we could get an exception to the zoning, I'd build a triplex there or a quadplex, as an investor. That's great for backfill. That's great for the ad hoc stuff. And I think what I'll touch on in the areas, and I see this, it's interesting that it comes up here, rural areas of populations under 7,000 in particular. Looking at that, I want to lean into a place that I'm fairly familiar with, a community just right down the road from where Courtney and I are sitting in Dietrich, and their use of residential TIF. There's a community that's not huge at all, and they came in. Probably now, what are we looking at, 30 or 35 years ago when they started doing some of this stuff, really laying the foundations that we see today. We see the fruitfulness of today with their original TIF plans and putting those in place to say, we're gonna take this ground, we're gonna do tax increment financing, and we're gonna offer incentivized lot purchases for residential new construction. And that's kind of the nuts and bolts of what they did. And they were very successful at that. They saw an opportunity of folks that maybe young people that wanted to return to the area and start their family, or wanted to live within a radius of where they work, or what have you, whatever the decision was. And now they've really caught gravity, and we see other communities. I believe was it Courtney Montrose is going to do 45 or 60 units or something, I think.
Diedrich definitely the trailblazer here for the trend to where the municipality, the village themselves were the developers. Right. They put in the infrastructure layered TIF to offset the cost of doing that infrastructure, sold the lots at a reduced rate, a heavily reduced rate, and really foregoing short-term gains to secure long-term revenue as a local form of government. And in doing so, have increased population significantly, especially looking at what's happened with their school as well. And over the last 10 years, when I first started here for the Alliance, seeing an average increase of 10 students per year, and that's even grown more. And the school has made some expansions. The community has grown a lot. Some significant things can happen. And Teotopolis has followed that trend. Altamont's currently in the process of doing it. Over in Crawford County, Robinson's working through that. We've got Risa on here who might want to speak something towards it. Oblong's looking at it as well. And various things that smaller communities could do, even if you're rural or even larger than 7,000 population. It's leveraging your local resources and leveraging those programs that you may have. And if you have an enterprise zone, we're seeing a lot of communities start to put residential components to the incentives offered through an enterprise zone to help encourage that private investment in residential development. So great question to start off with. And even looking nationwide, look at the state of Montana, and I hope I'm not misquoted, the state of Montana shifting zoning laws to allow multifamily in single family districts, effectively, donating an area, but it just makes sense in the recognition of being able to better utilize your existing assets and to increase housing, and how that residential from multifamily, single family, multifamily complexes can be very, very nice, very beautiful, and not really drive down or take away of any value from existing residents surrounding. Great question, Valerie. Thank you for that. Hope we answered it. Small plug, I'm on the board of directors for the Illinois Rural Partners. We're starting up our community showcases again this year, and October 24th, we're going to be in Dietrich Forest Community Showcase. We'll invite anybody to come to it, and going to talk to them about what they've done in housing and their single family housing. And we've had Brittany Brittany Gibson, the village clerk for the village of Diedrich, on a webinar in the past. So if you go to our YouTube channel, you go to the ilbusinessnavigators.com, you can see her presentation as well. But encourage everybody to come out later this fall and dive into the conversation of not only what they have done, but then what are you seeing in your communities, and how we can all work together to try to overcome these hurdles. I'll step off my soapbox a little bit there. There we go. Hey,
I
Matt,
think that was
yeah.
I think that was great, Courtney. And I just want to interject to follow up with what you said, the importance of housing development for things like school systems and what that does. As myself, as a former school board member, and school budgets function on a portion of property taxes and a portion of what's called GSA, or general state aid, which is a head count, dollars per student that attend so many days and so forth. And so, when I was on the school board up in the Thurston-Strasburg area, we were in the $5,000–6,000 per student range in general state aid. So if you add, 10 new students to your school population in a year, there's, $50,000–$60,000 using those numbers. I don't know what they are today, but using those numbers, that's staff salary.
That's a teacher.
That's paying down a school bus. That's all the things that you need to do, or just offsetting costs. That I can't speak enough to what residential development can do for the strength of local school systems.
Yes.
It's fantastic. And that's the way, in my opinion, those communities maintain that level and maintain that school system, maintain a lot of other civic services, is simply by growing their population base and growing their housing units. I think that's going to be critically important for communities.
Oh, most certainly. It supports industry, the workforce as a whole, increasing your labor pool, rooftop, retail follows rooftop, supports your commercial industry, support local small businesses. Everything definitely ties together. And Valerie, she lives in Diedrich with her husband, says almost bought land and built in the residential TIF district. That Brittany's Gibson is an amazing asset to the community and really pushing development. Everywhere I go, I say Brittany's a rock star. So I had to get that, state that comment. Somebody else believes it other than just me, Brittany. So if you're watching this, kudos to you and what the village of Diedrich has been able to do, and tremendous activity of what other communities in the surrounding area are doing to encourage that residential development. Matt, I want to go ahead.
I'm sorry, I was just going to interject. If you said, Courtney, that Diedrich was the trailblazer for that. We've seen so many communities in the Effingham County area follow suit with that. We've seen communities in the kind of other communities that are tangential. As you go north into Shelby County, Strasburg has a residential TIF. We see the community that I live in Sullivan. We see a lot of residential new development going on there, and utilizing TIF district, utilizing enterprise zones to offset the sales tax, or offset costs to those to those developers, is a wonderful thing. Those are tools that are there. They're sitting there. They're not costing anybody anything, and it helps capital deploy. If you're in an opportunity zone, whatever it is, if you're in a position where you have a favorable economy for capital to come into your marketplace, leverage that, advertise it, market it, put it out there, because those are the things that are going to make the decision of, if I've got my bucket of money and I can put it here, I can put it there, they're going to help you stand out. They're going to help your community going to thrive. And working closely with your lending partner institutions, local community banks, local credit unions, local facilities that have capital. They want to deploy capital. That's the business they're in. They want to have thriving, growing communities, and having them as early stakeholders and having them as partners in this throughout the continuum of the process. I can't say enough about that. Having our friends and neighbors being a part of this in our communities is really a critical thing, in my opinion.
Oh, I concur. We've got to mitigate risk is what we're doing. And, there's capital that's waiting to be deployed, as you noted, but we still got to have the correct economic climate and the conditions that fiscally makes sense. And to not only for the lender, but the borrower as well, to take those risks and to move forward. And, how did we get to this spot? And I don't think any big secrets that this question was going to be coming, but we just went through a pandemic, and how the housing market turned upside down, and to where can you run us through what you've seen pre-COVID, pre the pandemic, during the pandemic, and then now post-pandemic, where we're at now? What are you seeing for those ongoing market trends, the housing market as a health as itself, and just dive into that a little bit, if you would, please.
Well, I'll speak, and again, this is particularly my perspective, nothing more or less than that. When I started my career, I started in 2007 in Effingham. with a brokerage here in town. And when I started, Effingham proper, the 62401 zip code, I should say, would see anywhere between 125 and 150 residential units on the market on a daily average. The last day I looked at the MLS, the Effingham zip code 62401 had 35 units. And that's across the price band. You know, we talked about that earlier. So in Effingham, what that means is that's the cheapest house for sale in town and the most expensive house, which is probably going to be on Lake Sarah. You know, so you've got maybe a 45 or 65 or $75,000 house somewhere versus a 1.5 or $1.6 million house on the lake. And obviously, as buyers, we're not looking at the full price band there. You know, we're looking, we have a budget and we say, I need to be in a $325,000 house or whatever your situation is. And so you're looking at a perspective, and there may genuinely only be one house for sale in that price band. And then that's not even considering I want a certain number of bedrooms and bathrooms, and I like brick, or I like vinyl siding, or I want a ranch on one level, or I want a basement. I want to be on the north side of town, the south side of town, right? So a million variables that you can make out of this. I want a swimming pool or fireplace or whatever. You know, that's just simply the dollars and cents of what we've got going on. So, you know, that is that housing inventory reduction is something that I've seen from the start of my career till now. We saw it happening gradually over time up to COVID. During COVID, those years, we had cheap capital. We had work from home exploding. I dealt with a number of clients that relocated within Central Illinois. We had folks that relocated from Champaign to Effingham, just as an anecdote. And they said one guy was an employee, and he said, I never have to go back to the office again, and I don't want to look out my window at the stuff I see now. I want to see something that I like. So I'm going to move because I don't have to worry about it. You know, I'm going to move, and then I'm at retirement age, and I'd like to kind of take and springboard down here and do fun things. So we saw a lot of different influences during COVID. We saw a lot of different buyer and seller profiles. We saw folks hang on tight to stay where they're at. We saw folks, throw mud at the wall to try to get in a house. So a lot of different perspectives there. And in post-COVID, we're coming out of that. We still see a lot of variety of perspectives, but now we see this massively expensive capital comparatively, and I'm not trying to speak out of turn. I didn't buy a house in 1982 when interest was 14.7% or whatever. So I understand that, but we've also seen, kind of examining that, we've seen interest, compared to those highs in the 80s of interest, we're a third of what they were then. But what we're a third in the borrowing cost, we've seen a 7x factor in the value of that home. So you're borrowing money for a third less, but you're borrowing 7 times more the money in order to buy that first house. So there's definitely economics at play. But what we've got now is this very interesting confluence, Courtney, of we've got high home prices that are remaining stable and remaining high. We're starting to see just a gradual softening. Days on market are increasing. Price management, price reduction amongst brokered listings is starting to increase. Houses are sitting a little bit longer. Buyers are being a little more scrutinous of properties, or not willing to get into that bidding war, if you will. And they're also, part of that's the economics. They're feeling the pressure of the externalities in their life and saying, hey, we can buy here, but we want to buy here. We want to be at something that we're comfortable with affordability in case of whatever. But we're still seeing both high home prices and high cost of capital. And that's an interesting confluence, in that supply demand curve. That's really interesting to me. I think we're going to start to see those home values decrease, but it's going to be a gradual thing. As interest rates decrease and the cost of capital goes down, we're going to see increasing buyer opportunities for owner occupants and residential buyers, because more people will be able to afford more house. But we're also going to see, as home prices decrease and cost of capital decreases, we're going to see institutional capital get deployed, because there's certainly going to be a floor there where capital says, hey, we're in the business, we want to acquire 10,000 residential units across the nation because to build a rental portfolio or whatever. And we're going to see that capital start to get injected, in my opinion, in marketplaces, as we have in anybody on social media or Google or sees a sign on the road may see signage that says, we buy houses for cash, call 123 whatever number. And that's a very real thing, both on a micro and macro level. That's a very real thing. If your next door neighbor that has surplus capital that says, I'd buy a house, it's a good investment, and institutional investment that says, we'll buy 10,000 units or 100,000 units. because we think it's a good investment and how they deploy their capital. So I hope I kind of touched on that question.
Oh yeah, I want to
Interesting
dive into
thing,
it a little more.
how we got here to where we go next.
I love it. I love it. Well, and two things. So pent up demand. Is there really pent up demand? And we touched on a lot of things, and looking at, you said 35 years is the average of starting for that
Mhm.
first time home buyer, and kind of the shifts that consumer behavior and you know, those younger adults moving back into home, and just how those family formations, those household formations are shifting. But is there pent up demand? Or we talked a lot towards the unwillingness, or really not wanting to forego or let go of that fixed mortgage that's at a lower interest rate now, and just what the significant increase that could be, even at current today's, or even if you get into 4, you're still paying more, and just the assumption that most of the mortgages are around 3, or maybe even sub 3 in that sense. But and then if rates do come down, if there is truly pent up demand, and looking at a demand and supply thing, will we see a decrease in home values, or will that increase in that demand increase home values? Because the supply, it's a short-term equilibrium versus long-term equilibrium, and the supply is going to take a longer time frame to be able to come on. So you're leveraging your existing housing stock, and if there is a significant increase in demand, is that going to drive prices?
Yeah,
Maybe a little.
fantastic
I
inquiry.
went way along on the question. Sorry.
I think you hit the nail on the head. I think
Yeah.
we're going to see whatever near term is. The X factor is the temporal question. What is the term of near term versus long term there? You know, and when do these things kind of sort themselves out in the marketplace? And some of that is reactionary. What happens with interest rates, and then how long does it take for the market to absorb that, and so on and so forth. But I think we are going to see a short term dip in favor of a long term acceleration. We're going to continue to see home values increase as an asset class. I do believe that. I believe it's you know, it's definitely something that we're going to see increased new construction. But it's always going to be in equilibrium, as you mentioned. We're not going to see anybody go out and say, I'm going to go build 10 million new houses. Who am I going to sell them to? I have no idea. That's not going to happen. Capital is not going to deploy unintelligently. So we're going to continue to see stabilization there. But I do think we're going to see a continued rise in overall home values, with a short-term reduction as we find that equilibrium. One thing I'll mention anecdotally, and I have no data in front of me, I'm just kind of repeating that article I read. The first time in history, and since this metric has been reported in 2024, I believe it was, we saw home buyers become pre-qualified borrowers, meaning they went first to their lender. They went to a lender, they went to a financial institution first to start their conversation in the home buying process, versus coming to a real estate agent. The first time since that metric's been reported, we saw people go after the money before they went after the home, which tells me that, one, we've done actually a good job educating people, saying we need financial qualification, you need to be prepared for this, so on and so forth. But two, there is pent-up demand, such that we see those people qualifying themselves, putting themselves in the marketplace, even though we as brokerage practitioners may not know they exist. They're there. They've had those conversations. They've started that stuff, but they're not maybe on our radar yet. So I think that, to me, I interpret that as speaking to the pent-up demand, where we start to see those metrics suggest that we kind of almost have a shadow pent-up demand, right? Due to the availability and the advent of these fantastic informational tools. The information is publicly available. Real estate agents aren't gatekeepers. You don't need me to know the house is for sale. You've got a lot of resources to find that. But I don't know that you're looking, right? I don't know that you exist as a home buyer. So maybe I'm not targeting you, or we're not interfacing as efficiently as we could, because you're on your path and I'm on my path. And sometimes those are parallel, but we haven't come into contact yet. So I hope that spoke to the question. I do see all that as pent up demand. So I see smart capital being deployed for new construction. And I think we're going to see that a lot in areas where we have, you know, a really aging housing base. We're going to see the economic viability of repairing houses just be exceeded. You know, the capacity to repair this house is just not there compared to let's build something new. That's my 2 cents. So
we're getting close to the 12 o'clock hour. We've got a few questions
Okay.
still. Going to try to get to as many as possible. Have any questions, throw them in the chat. If we don't get to them, we'll try to answer them and get them sent out next week as well. Earlier in the presentation, Freddie had another question. If there's so many cash buyers and those using conventional financing, why is there more new residential construction? And just even kind of looking at M2 money supply, we've seen most certainly a growth in that trajectory of M2 over the long span of multiple years, but then a hit in the pandemic and just a short dip to that, and really kind of stable. I mean, the yield curve from a financial side is upside down half the time, it seems like, anymore. But but M2 is down a little bit, but still significantly higher than what it has been over the last 10 years. So to note, there are cash buyers versus those conventional financing. How come there's not more new residential construction?
And I think to speak just very bluntly, I think we
Yes.
see a lot of new residential construction. I think we see a lot of capital being deployed. It's just not being deployed here. We're seeing it in areas where we see population growth, and frankly, Illinois and Central Illinois is lagging compared to several other areas of the country. Again, I kind of referenced the Sun Coast. Folks are moving to climatologically more favorable areas. Even it's not just a haven for retirees or a geriatric development. Young people are moving. Young people are saying job opportunities exist, technology opportunities exist. I'm going to relocate to Austin. I'm going to relocate to Tampa, wherever it is, whatever it is. And so if folks have a demand to relocate and say, I don't need the cold weather in the wintertime, and my job prospects are limited in Illinois, maybe I've got the job here, but I've got a more exciting job there. That's where the capital is going. And I think that residential development, which just creates a snowball effect of the more residential development you have, as Courtney said, retail follows rooftops. Now you have more goods and services being offered. Now you have more quality of life being offered. You have an enhancement of the school system, on and on and on and on. And as long as they're growing, they're all growing together. So you see the enhancement in communities and the importance of that educationally, K-12, post-secondary education, professional services that are offered, financial services that are offered, governmental services that are offered. All those things thrive and they do better when we have more rooftops. We have a bigger pie, we have smaller slices of the pie, so on and so forth. So I think that's there. And I think the important question for us is, how do we overcome that challenge in Central Illinois of saying, we know that we're not Austin, Texas, right? We know we're not Tampa, Florida, but we have absolute strengths. We have
tremendous
natural beauty. We have natural resources. We have a tremendous Midwestern work ethic. And how do we deploy that with our shareholders, stakeholders, business partners, and enterprise partners to say, we have these great things to offer, and let's make it favorable for capital to flow here. And that circles back to some of the things that local governments can do, in my opinion, to help enhance that.
No, certainly. Yeah, we got to leverage our existing assets and mitigate risk, and just encourage that private investment and continue to grow our community from multiple factors. And loved it. Great Q&A. I think that's an excellent one to end on. I had more questions. I'm going to call you later, but most certainly appreciate the opportunity here to hear from you, Matt, and to dive into the housing market and to have a great conversation. And want to invite everybody to join us next month. So there again, we do these monthly webinars last Thursday each month. August 29th, we're going to dive into the topic of cannabis in the workplace. So going to be a good one. Got Brian Wacker from the Cook Group, got Chad Thompson from North American Lighting. So going to hear from the attorney side, going to hear from the industrial employer side, and have a great conversation. But hope everybody found today's presentation informative, enjoyed it just like I did. Again, Matt, thank you for presenting, and we hope that everybody has a good rest of your day. Have a good day, everybody.
Thanks.